Shorting or short selling of a stock has recently become more mainstream because of a sudden rise in price of a particular company whose stock price was expected to decline for 2020 and 2021. One of the ways of making money through stocks is by a method called shorting, and this is where money is made based on the prediction of a stock losing its value. The definition of shorting or short selling, according to Investopedia, is that it's an investment or trading strategy that speculates on the decline of a stock or other security's price. There's a disclaimer here that it's an advanced strategy that can only be undertaken by experienced traders and investors. So we know based on this that there's money to be made based on the decline of a stock, but that's confusing in itself because if a stock is going down in value, how exactly can you make money from this kind of situation? Well, with short selling or shorting, you end up borrowing a stock that you expect is going to go down in value. And once you've borrowed the stock, you sell it for the current market price. Then over time, as the stock that is expected to go down in value goes down, you buy some of the stock and give it back to the lender who you borrowed the stock from. So you've bought the stock at a lower price and given it back, despite selling the borrowed stock at a higher price previously. That obviously sounds very confusing, so a good way to imagine this is with mobile phones. Let's say that you borrow an iPhone 12 from a friend and sell it for $1,000 because that's the current value in the market for an iPhone 12. You then wait for a year for the phone to go down in value a bit, which is something that's quite common when newer phones and models are released. After about a year, the phone is worth $700, so you then buy one at $700 and give it back to your friend, even though you sold his for $1,000. So you've made $300 from this transaction because you borrowed one and sold it for $1,000, and then you bought one for $700 and gave it back to your friend, so you keep the $300 difference. A problem may occur if what you have borrowed goes up in value. So imagine that that phone is a limited edition model, and when you borrow it, it's worth $1,000, so you sell it, and then after a year it's now worth $2,000. You buy it to give it back to your friend, but it's costed you $2,000 instead, so you've now lost $1,000 in this transaction. These same principles apply to shorting stocks or short selling, and it's a very risky strategy because the price of any asset or stock can rise very quickly. However, there is still money to be made, and short selling stocks has been a method of making money in the stock market for a long period of time. If you're able to read financial statements for a company and kind of recognize when the value of a stock price is overinflated, then there is a potential for money to be made with very little initial investment.